All right, good afternoon, everyone. happy to have you with us. Today is Wednesday, February 12th, 2020. We're going to do a updated PTG Methodology Overview. We did one a while back, but again, we've had some changes since then to various aspects of what we do, and thought it would be a good opportunity, along with our guests, to give an update on where we stand at the beginning of 2020. All right, so before we get going, again, I do have to outline the NFA Compliance Rule 2-29, and you're all familiar with this. All right, hypothetical performance results have many inherent limitations. I'm not going to describe all of them here. You're familiar with them for the most part. Certainly the disclaimer that trading in futures and any derivatives on futures is speculative in nature and involves substantial risk of loss. Past performance is not indicative of future results. All right, so with that out of the way, wait a second. Oh, I did this with Infinity Futures. Okay, so sorry, hold on a second. Let me get rid of that. That's a faux pas. Okay. All right, so for those of you that are relatively new with us visiting, you've probably seen this in the webinar when we did it, but I just want to pass it along again. So what I want to talk about is our four-pronged mission here, and again encompasses a lot of details underneath each part of these 4 points, but these are the main 4 points that we want to try to get across to everybody during our mission here. And again, we've been around now since 2013, Polaris Trading Group has, and I think we've been successful at each of these mission points, but we want to just highlight them once again before we get going on the review. So we want to improve our decision-making skills. All right, so it's not enough just to know how to trade and so forth, but really one of the core factors that I want to pass along with my experience and everything that we've built here is to help you improve your decision making. We actually, in fact, have a decision matrix called the OODA loop, OODA, which stands for Observation, Orientation, Decision, Action. And we did an entire workshop on it with our members. And the idea there is to be able to improve upon your observation skills, the orientation of what the market is showing us at any point in time in the session, and then when it comes down to the decision and action part of the decision matrix. So we want to improve our decision making skills. If we improve our decision-making skills, that's a core fundamental skill set or competency that as we get better at that, we will be able to identify better trade opportunities, be more informed about what we would be wanting to do at any point in time, and be able to execute those more effectively. So that's one of our mission points. The next one here to the far right is learn new empowering trading habits. So you know only for yourself what type of bad habits you have, and we all have some. The idea is we want to try to work on eliminating our less useful habits, let's call it that, less useful habits, and really learn new empowering ones that take us to where we want to go. All right, if we've built a habit that's not moving us in the direction, okay, of where we want to go, then it's not a habit that we want to keep. All right, number one. So all right. Let's see. Hold on a second. I guess somebody has a chat open here or something. What do we do? No sound, just waiting. Tom Harney. Tom, can you hear me? Tom, can you hear me? All right. Everybody have sound? Okay. Okay. All right, because I'm running two rooms. I didn't even see the other chat. All right. Okay. We'll continue on. All right. So learning these new empowering habits. Okay, number one. Number two, actually. All right. Thirdly, we want to demystify price action. So there's a number of people out there that I've come across over the years that they're somewhat clueless. Again, they know indicators and they know certain concepts and so forth, but they're somewhat baffled at times about what is actually going on, whether it's, why did the market move to this direction or what happened over here. And again, so the idea is we're trying to take kind of strip down that veil of the market, pay no attention to the man behind the curtain. Well, we want to see what's behind the curtain. Okay, we just don't want the market moving around and not having some understanding of the auction process. Okay, and so we want to definitely make sure that you understand the core of the auction process, and again, you become a more informed trader, and that's our fourth point over here to the left. All right, so there's two categories of traders that I identify, and I've learned to identify over the years, and how I was taught is there's the informed trader and then there's the uninformed trader. That does not mean inside information. This means that you are knowledgeable about market action, the function of the auction process, and all the nuances that go along with that. Okay, and that's really quite important to do and to know. The uninformed trader, okay, is somebody that simply does not have much of a clue. Now, unfortunately, I've come over my experience. There's been a lot of people that trade a lot of money for others and for big institutions, and they don't really have a good, they're of the uninformed group. Okay, so again, it doesn't really matter how much money you have to trade. All right, you could have a small account and be a very informed trader, and vice versa. So we want to make sure that everybody here is informed, right, to the best of their ability, right, and the ability that we can provide for them. All right, so those are just the core, and again, there's a lot of subcategories underneath those. I'm not going to get into any of those details in this presentation. So where do we go? So these are some of the methodology overview topics that I'm just going to hit upon today. And we're going to do it more in chart graphic form. We're going to go right to the charts, and we're going to discuss briefly the topics. All right? I'm not going to get into details of each of the topics because, again, that is, each of the topics itself is probably worthy of a long workshop. All right, and in many cases we have pre-recorded workshops that we've done in the past for many of these topics. All right, so just to kind of give you an overview. So everything starts with the daily briefing. Okay, so the daily briefing everybody has access to. There are links at the beginning of the chat room, beginning of the day. There's core links there, and you have access to the daily trade strategy briefing. Now, you can also find the daily trade strategy briefing, okay, on the website. I'll bring that into view right here. All right, on the website, and you just simply go to the PolarisTradingGroup.com right here under the blog section. All right, and the daily trade strategy. Okay, so click on today's. All right, and again, you've all perhaps seen this already, but I walk through the various aspects of, there's just some general market commentary, economic calendar to get everybody going. And then I comment specifically about the S&P, whatever that cycle day may be for that, and what we're expecting to happen based upon the cycle day. Bullish and bearish scenarios, so there's always going to be what we call a line in the sand, all right, that we begin with the day with. We usually have a graphic, all right, to help support the text, and I also speak of the NQ, okay. I have gotten requests for crude oil and others, but frankly I've refrained from doing that simply because this takes me a fair amount of time in the morning, and I do want to keep the cost for those that are subscribing to this. I want to do want to keep the cost at a minimum, as well as this is also part of your membership benefit. Okay, you'll have access to this daily as well. Okay, so that's where we begin, and again that kind of dovetails somewhat with the 3-day cycle analysis here, and we'll get into that in a moment. Again, many of you are here because we've just done a webinar with NinjaTrader Ecosystem about the 3-day cycle, so we will talk a little bit about that. Volume profile analysis. Now, I am not specifically a profile educator. There are a lot of venues out there and educational resources that are very much worthy of this topic. I've learned profile and reading footprint charts and all that back in the very early days, in the early 90s. Right? Yes, 1990, before the year 2000. While I was working for the investment banks. Right, back in the early days of market profile, the Steidelmeyer days and all that, the investment banks and trading houses, they had a lot of the stuff that is now available to the public. Right, we had it in the early days back then. So, but I am not really. We do talk about the profiles, so I think a lot of folks that come, here to us have some knowledge about the profiles. And what I do talk about in terms of the profiles, whether we're talking about value area highs and lows, and any of those aspects of the profile, I keep relatively simple. Okay, again, there's a whole, litany of types of strategies that people use with profiles. I do not get into those here. But I will talk about initial balance highs, initial balance lows, which is the first hourly high-low, value areas. One of the strategies that is fairly popular and that we do, though it's not core to what we do, I do talk about it and at least provide an opportunity for everybody to be knowledgeable about it, is when the market kind of dips down through the initial balance low or initial balance high, and then snaps back up, right? So they go test it, and it recovers back up. That is actually a trade out there in the communities out there that use value highs, value lows, break of value highs, value lows, and again, there's some strategies that everybody should be somewhat familiar with and out there. And again, I can direct everybody to various resources, at the appropriate time. All right, and again, the Taylor 3-day cycle, most everybody is somewhat familiar with that now. That's here with us. Again, I talk in more detail on that every day. If you do want to find more information about that, okay, so go to the website and under the trading tab, click on PTG 3-day cycle. And again, it'll bring you to a landing page on the website where you can read about that. You can click, if you haven't done so already, you can click on the 3-day cycle document. Okay, this is our interpretation of George Taylor's book, which is really difficult to read. So Rich and I have collaborated. My partner Rich collaborated with putting this together, and we tried to make it a little bit more. Let me click on it anyway, so give you a look. All right, so it just brings you to a Dropbox folder, And again, what I tried to do here was simplify the concept, all right, of the 3-day cycle, the idea of smart money, all right, some of the basic concepts and assumptions, all right, about the cycle, understanding various terminology in there, violation, penetration, what does all that mean? Okay, the idea of acceptance and rejection, and then we go basically into the idea of each of the cycle days themselves. Okay, and then we give examples. All right, these are just core examples. Every day is, might be somewhat different, but this would be acting as an initial template, all right, for everyone. Cycle day 1, cycle day 2. So again, today was a cycle day 2 in our session. Again, we're expecting a little bit more of a range action, which we indeed got. And then what you would want to do now is read about the cycle day 2 and then into the cycle day 3 of what the expectation, would be going into cycle day 3. I'm not going to go into that right here, but this is the resource that you would want to access. Okay, and then there's some final thoughts about what constitutes a positive 3-day cycle, and which has a very high statistic, okay, of being accomplished each cycle. So what you'd want to do here is get familiar with the cycle. Okay. Now again, there's obviously various interpretations out there in the trading community about the cycle, how to trade the cycle. Okay, what constitutes the various cycle days and variations. That's great. That's what makes the world go around. That's what makes trading fun and active. This is our interpretation of what we do with the cycle, and how we would use it as a guide, all right, for our trading. So there's also some educational videos on that same landing page, which will help describe the ebook, okay, which is the spreadsheet that everybody has access to during their trial with us. All right, so do get familiar with that, and that will expand your knowledge about that. So that's part of a kind of a core part of the methodology here as well. Okay, and then once we have the kind of the daily trade strategy, the levels, and what we would be anticipating for the 3-day cycle, then essentially that forms the kind of like the foundation for the day. Okay, 3-day cycle levels are static. They don't change throughout the day, except there's one that we do have, one that does change dynamically through the indicator that we have. But for the most part, everything else is static for the day. The spreadsheet, by the way, is distributed usually no later than 5:30 Eastern time. So if you're a trader that is in the Euro time frame, or you are trading, Shanghai, Nikkei, after RTH session, the levels are as valid then as they are during the RTH session. Okay, so a lot of folks certainly are in Europe, and having this on their desktop at the end of business, at the end of close, ready for the next sessions, is, again, you're prepared. All right, so we always like to say we prepare, not predict. All right, so none of this stuff is predictive. All right, but in preparation, knowing what the ranges or the expected ranges would possibly be that day, again, can add an edge to your own trading. So once we have the foundation, then we move into the more active part of the methodology as the day unfolds. Okay, so there's different pieces of our methodology that we intraday that we look for. So we begin the day RTH session with what we call our opening range strategy, and I'll show a graphic about that. I just want to get through the topics here, and then we'll zoom in right to the charts themselves. All right, so the opening range strategy, everybody's been watching me trade the opening range strategy now, all right, since we've been here, again, every day. It is a very mechanical strategy. All right, it is black and white, all right, when it comes to the rule set, okay, the way we have done it. Now again, Other opening range strategies out in the world, everybody has their own spin and how they want to handle it. This is how we do it. Okay, so and we do have our opening range auto trader that will assist in doing that. You don't have to trade opening range on an auto execution basis. We do have that available, so you can certainly do it manually. But again, if you follow the rule set, all right, and again, as members here, you will get all the details of the rules, all right, that we have on the opening. But if you do follow the rule set, then you know you'll. It's just again another kind of arrow in your quiver to you know, as part of the method. Now, one thing I want to just make a point at. There are different aspects of our method. Not everyone, and I know this for a fact, not everyone in our membership trades the exact same way. Okay, styles are different, risk tolerances are definitely different, but there should be something within our method that should attract and resonate with everybody. If there's something in our methodology, if any part of our methodology doesn't resonate with you, I would be very, very surprised. Okay, because the way this has been developed is there's different sections that whether it's the opening range or whether it's you know, continuation moves throughout the day or pullbacks, all right, within the context of trending action or range action. There's something for somebody, all right, in here, because this method really encompasses a multitude of disciplines that I have learned over the years, and I've kind of incorporated them into the various, you know, segments. So opening range strategy is one of them. We have another category called the bull and the bear stacker. Okay, so again, without going into too many details, the idea is we're looking for, on a bull and a bear stacker, we're looking for a shift in the underlying dynamics from a bearish condition to a bullish condition. And we want to get on board that new condition as early as and efficiently as effectively as possible. Okay, so again, we have an actual trade setup that helps us, you know, do exactly that. Identify when the market is shifting from a bull to a bear and vice versa, and to get on board in that. Okay, premium and discounts. Now, this is our CCI crossover strategy. Okay, and again, it is a strategy. It is designed to, once we have an established direction in the market, in price action, we want to then be able to effectively get on board that when there is some sort of a pullback in price. Okay, so primarily premiums and discounts represent pullbacks within the context of a developing directional move. Okay, so a discount is referred to as a long entry. A premium would be referred to as a short entry in that direction. Okay, and we use the CCI, the Commodity Channel Index, and again, we did not develop it, right? But we did, the way we use it is our proprietary method. All right, and we have, and again, we have an auto trader. It's called the Auto Trade Assistant, that will execute a certain specific criteria on that strategy itself when the setups occur. The ATR, the average true range. All right, so everybody is familiar with average true range to some degree. Okay, the average true range is a measure of volatility, and there are a multitude of calculations about the average true range. So in other words, there's the 10-day average true range that we can use, or we can use an average true range on a specific time frame. So for instance, an average true range on a 15-minute time frame is much different than the average true range on a 1-minute time frame. Okay, but the average true range can be used effectively to act as what we call a structure line. Okay, and I'm going to digress a little bit here, just give you a quick story about the average true range. When I was at the investment banks, um, on the trading desk, we had certain small groups that we broke, we broke out into these small kind of work groups, and each work group was assigned specific topics in order to come up with some novel, interesting, effective, and certainly hopefully profitable ways of using various, whether there be an indicator or some strategy or some method or something, okay, some tool. And so the committee that I was on, the little work group that I was on, dealt with the average true range. Okay, so we picked apart what the average true range is all about. We discussed at length various ways of using it, how institutional accounts use it. So majority of the work trading that we did was on behalf of large institutional accounts, the big mutual funds of the world and hedge funds and so forth, as well as retail, in-house retail customers. But again, the big money folks are the ones that really pay the bills out there. So the group that I was working on, we came up with interesting ways of utilizing the average true range, and then providing some creating some tool sets for our institutional customers. Okay, it wasn't simply for us proprietarily, but for institutional customers to help utilize. But we would then guide them on how to use it. Okay, so our average true range stop lines, if you will, or structure lines, is an offshoot of my years when I was at the investment banks working on in this group. And our ATR lines, as you'll see, and I'll show them in a few minutes here, they are true structure lines. Okay, they act like no other ATR lines. Now, most trading programs have ATR lines built in, all right, and they're useless. I have built our own ATR lines where they are quite effective in establishing trades. All right, we have an actual trade setup that references the ATR structure line or stop line. And then the last category we're going to talk a little bit about is the XMO. XMO simply stands for cross of momentum. Now, to give a little backdrop of the PTG methodology over the years, particularly referencing the premium and discount CCI crossover strategy, that has been primarily a pullback strategy. All right, the market makes a move to the upside or to the downside, breakout to the up or breakout to the down, and then we wait for, we look for that pullback, particularly the first pullback following a break. Now, though that is very effective today, right, and it still will be effective for years to come, what's happened with that, though, is the way the markets have evolved with these algorithms, all right, over the years, there is more of a thrust move through levels that effectively don't pull back like they used to pull back. All right, so typically what would happen is a level would break out and they move up, and then price would pull back a little bit, and you get an opportunity to get on board early. Well, today a lot of times when it breaks out, it just grinds, higher, 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 or lower without really much of a pullback. So having recognized that, and we never really had here a quote unquote breakout type strategy. So the cross of the momentum is that for us. All right, and again, it kind of along with the bull and the bear stacker setup. All right, they're similar, but definitely a different animal. All right, when it comes to how they're calculated and what they show, but they're both of a category of more of a very early directional move, and again, particularly the cross of momentum, which I'll show you how it looks here on the charts. That is very effective. So instead of waiting for, watching the breakout occur and then waiting for that pullback that may never come, and then you sit there and you say, damn it, the market's just up 5 or 6 or 7 handles and we don't even have a pullback, right? So wouldn't it be nice to get on a directional momentum move? Now, momentum doesn't mean fast. It just means, I look at it as momentum is persistence, right? In a direction, I just view it as persistence. So to be able to get on something, that has persistence or sustainability early tends to be more effective than just waiting for a pullback. Now that pullback may occur and we may get a beautiful premium or discount, and then there's a continuation move beyond that, and we certainly will still look for those. But what would happen structurally, the market will make a move first before that happens, before a pullback happens. And again, like I said, years back, they used to be small moves where you can get on, and then the major move or the larger portion of the move continues. So this is an addition, not too long past, maybe last year sometime. Actually, yeah, probably the beginning of last year, maybe a year now, that we've added a cross of momentum, and so this offers us an opportunity to get on a directional move, all right, with efficiency. And the interesting part about how we look at this and what we look at in terms of the trigger signal is there is a contingency of algorithms out in the world that specifically use what we have. Okay, or again, they're not using, in other words, the signal that we have is anybody can generate it. Okay, it's not proprietary to us, but the nature of how the momentum cross occurs, there are a number of algorithms out in the world that utilize that. Okay, all right, so that's really the end of the PowerPoint part of the presentation. Let's get to the fun stuff. I just wanted to give you the outline. Please let me know if you see the cycle chart. Okay, make sure we're seeing what the cycle chart shows us. All right. Does everybody see the cycle chart? Just say yay and nay. Okay, great. Thank you. All right, so again, you can watch the videos. You can go to that site on the website about 3-day cycle. Okay. Barbara, you should be looking in the Zoom room. Okay, you need to be on Zoom, please. There's a link right up there. Tom's provided the link, so just click on that and you should be, it'll zoom you right into the room. We're on it right now. We're open with it right now. We're doing the review. If you can't make it, it'll be recorded. It is being recorded. Okay, so again, the idea here of the 3-day cycle, again, we've gone over it. This is what starts our session every day. So again, the daily trade strategy contains a lot of information about the 3-day cycle, and this is the indicator here that I was referencing that will display all the levels and targets and ranges that we look for the 3-day cycle. Okay, so again, not going to go into the details of each cycle day here. I would recommend everybody to watch the videos and download that document, which is a free document for everybody about the 3-day cycle, and you will get more detailed knowledge. As with anything, it will take time, right? You can't expect to be a brain surgeon overnight. It does take time, all right, to work. But again, if you are willing to take some of the time and efforts to learn this, it may change the way you view, and again, 1 or 2 trades can make your, performance a whole, difference. So, all right, so this is provided for every day. So this is the indicator. So you would get this indicator. You have the ability to purchase this indicator with a subscription. All right, but again, on your trial currently, you have access to the spreadsheet only. All right, but this is essentially being pulled from the spreadsheet, and you can see up here for today. All right, the possible high for today was 33.81. Now, this is still valid until the new numbers come out for 6 p.m. for the next session. So prices have exceeded the prior high, which is the cycle day one high, and in this case, the upper targets here, which we briefed on this morning, have gotten fulfilled. So 80, 81s, 82s up here. All right, coming up to, so again, another section between 82 up through 87s are still in play. So these levels could get fulfilled during the overnight. All right, and clearly we're still in an uptrend, so we would not want to be shorting any of this at this stage. All right, so we were talking about the opening range. Okay, so on the opening range, again, once we have the foundation of the daily trade strategy and the 3-day cycle, we start our opening range. So the opening range, and again, the details and the rule sets for this will be all contained for members. All right, but so I won't go over all the individual rule sets. But as you can see here, we execute the opening range. So basically, the opening range is the first 3 minutes that we use. Now, some people use different time periods. Some people use 30 seconds. Again, we use a 30-second time frame on the NQ. Some people use 15 minutes. Again, the opening range can be defined in many, many ways. All right. We use a 3-minute on the ES and 3 minutes on the crude oil, but that may change soon. We're making some adjustments there, and we use a very fast 30-second for the NQ, which has had very good results. Now, again, this strategy is very mechanical, and again, you can certainly execute it manually, but if you understand the concept of the opening range, and again, so if you go into, let me just show you here, as a member, okay, so you click on your account, all right, and you have educational materials, okay, you have Wednesday workshop archives, which is a slew of videos, okay, but let's go into the educational materials section here, and I'll show you. You have the opening range strategy here, all right, so if we click on the PDF document, okay, this explains all about the concept of the opening range. Why is it important, etc., etc., the opening range principle and the psychology of it, understanding the nature of gaps within the context of the opening range, and then we offer some examples of different types of openings that are available. Okay, so what we've done here is we've taken the concept of the open range and we put it to use. We've kind of mechanicalized it or into an auto execution. Okay. All right. So we're looking for a break above the 3-minute high or a break above the 3-minute low. Typically, the stop is going to be on the opposite side of the range. Now, today was a little bit of a tougher sled because we have, again, on a cycle day 2, the expectation is a little bit more of a sideways consolidation, and we certainly got that, and we didn't really get a clean breakout outside the opening range, whereas on other days, okay, like we saw here yesterday, all right, we got a nice clean breakout of our opening range and achieving some targets. Okay, so not every day is going to be nice and clean, but the goal is to take the opening. There is a statistic out there that the opening range the opening range price will be within 5% of the high-low of the day's range by the end of the day. I think it's like 73% of the time. I'd have to check that statistic, but it's a very high statistic that the opening will be, within the high-low, within 5% of the entire range of the day, a very high percentage of the time. So there's a lot of folks that trade the opening range in different ways and forms. All right, we have our own. Uh, Somebody has asked me about, are the targets Fibonacci's? No, they're not Fibonacci's. They are specific, what we call frequency zones. All right, we've done a lot of back testing, and we continue to do current testing to validate each of these zones and levels. And so each of these targets are specific high frequency levels that we have historically seen that prices will go, stop at, reverse, get fulfilled on a very high frequency basis. Okay, so again, this is one of our setups here. All right, that we use. Again, it is a strategy in and of itself. So we have some folks that come in, trade the opening range, and they're here for about an hour, and then they go off, for the remainder of the day. For those that do remain, okay, we have other opportunities and trade setups, and we'll go over those in just a second as well. All right, the next chart that I want to show everybody is what's referred to as our balance chart. Now, this is a 5-minute chart that we use, and just focus on the right-hand side here primarily today, all right, for scaling purposes. You'll see here on the right-hand side, there's a lot of labels, okay? And what the labels represent are various aspects of whether it's profiling, the initial balance, right? So the initial balance is the first hourly high-low, the open range itself, right, that we just spoke of, and different key range extensions from those points. So the opening range and the opening range extensions. This particular chart was one of our early works when we had TradeStation. So if anybody have ever used TradeStation back in the early days, they didn't really do a great job with profiles. And so what we had to do is actually had to create our own modified levels profiles without actually having the profile visuals, which means we had to calculate the point of control, we had to calculate the upper and lower value areas, we had to calculate this, second standard deviation, which we refer to here colorfully as Jimmy 2 times, and third standard deviation away from the mean, we refer to that as 3-time Charlie price jam. So these are some colorful terms that we use in the early days. We've just kind of carried those forward. We thought that they're just fun, and carried those forward. And you can see here as well the initial balance high low, and then midpoint on the right hand side here where I'm pointing to. Again, the midpoint is the key metric of the session at all times. And then once we get beyond the initial balance high, we have our initial balance high targets 1 and targets 2, very symmetrical targets and so forth. So this kind of is a quick, if you wanted to, instead of having to sit there and calculate, what the various targets are, again, these automatically adjust for you daily, all right, at each point in time of the day. So again, this is a core chart that we look at. Again, part of the overall structure. It's an easy to read 5-minute chart looking at various pivot levels, support levels. You can see, for instance here today, you can see where the prior pivot high from yesterday became support over here during the day. Okay, there should be nothing magical about that. Typically, prior highs that were acting as resistance, once broken through, all right, typically act as support on the way back. So that's what we call the law of alternating pivots. All right, so pivot high resistance now becomes future support, and sure enough, the market does react that way. All right, now having a little bit of that knowledge could go a long way. All right, so it could go a long way. So simply having been able to identify a prior resistance level, and all of a sudden I'm going to anticipate that becoming support at some point in the future, and if and when that does, I'm looking to buy those. All right, establish a position there. Again, that could be an edge just simply in and of that. Very simple concept, right? Knowing, this is the idea about being an informed trader. Some people just don't know that. Many of you here, I'm sure, do. A lot of people don't know that, and again, that can make the difference between, a profitable trade and an unprofitable trade. All right, being in the structural area. One thing about our method, let me just make a point clear here, is that we are not scalpers. All right, I don't sit there and scalp all day long for 6 ticks or 8 ticks or 7 ticks back and forth. If you are of the scalping, uh, you know, style, all right, and you're having success with that, that's terrific. All right, but when you are scalping in that mode, you're really bringing yourself down to the level of those fast algorithms, okay, those high frequency traders, and again, things can move lightning fast, certainly in your favor, but as well as against. And what tends to happen is if you're an order flow scalper, all right, you're not going to really be looking at charts all that well. You're going to be looking at the order flow, DOM. Okay, and again, there's nothing wrong with looking at order flow. We focus at certain times on order flow because we want to see what the movement of that at certain times is. But unless you're a very large contract trader, all right, you can make a very nice living, scalping for 6 ticks, if you're trading 100 lots. Okay, but again, to trade the 100 lots, you have to have capital. All right, so whereas most of our membership does not trade 100 lots, all right, or anywhere close to that, we're looking for structural locations that we can position. Maybe you can only trade 1 or 2 contracts. Don't have a big account size. So it becomes critical to find key locations. All right, so once we have those key locations, again, I do hopefully a pretty good job in identifying those for everybody, and then it becomes your individual responsibility to take what I will always guide, and again, Barbara and others know this that have been with us for a long time. I will always guide everybody to a low risk zone, okay, what's at least perceived to be as low risk as possible. So we're always going to keep you out of harm's way. And then it becomes everybody's responsibility to get into the trades according to various setups. So with that, let's talk a little bit about the structure of some of the setups. All right. Let me move to the next chart. I'm going to go into Sierra a little bit here. All right. And this is one of the core charts that I look at on my side. Okay, I got a couple differing views here, but we'll kind of go through this setup here. On the left-hand side, all right, we have profiles. Okay, now this is Sierra, so Sierra comes with some built-in tools, really nice. All right, and then 60-minute chart, and of course the 60-minute chart here has all the cycle levels that you guys have just seen on the Ninja charts. All right, same levels and so forth. All right, we just have profiles on here. A little bit easier to read with the profiles. The 5-minute chart, the balance chart, again, no different. All right, everything is pretty much the same with the kind of the key levels that we spoke of. All right, so that's the balance chart. And again, so you'll notice it's tops down, next level down, 5-minute, and then again our opening range. Okay, so there's just a different look on it, but our opening range, no different than the other one. And then here's one chart I want to discuss a little bit. Okay, and this is our ODA loop matrix grid. Okay, so we talked about the cross of momentum earlier as a trade setup. So let's just talk about the grid here for a moment. Again, I'm not going to go into all the details. There's 7 biases, though, that we monitor, that we focus on. All right, and the bias, so these are all market trading biases that we want in alignment, or and the biases will be at different stages throughout the day. All right, but we love it when they're in a full alignment. So what we would call a sea of green. So over here, right here, you'll see all the columns, they're all green. So when they're all green, it's very bullish. okay, and then typically, the market will have a tendency to move, nicely, okay, when we get to that point. Um, so the 7 biases, the biases 1 through 3 are a little bit more sensitive. They flip back and forth quite a bit, but the biases are related to volume. Okay, so we track volume deltas, we track momentum. Okay, those are the 3 core biases that we look at, and we look at it on multiple time periods. And then bias 4 through 7 are varying degrees of trending conditions, okay, that we look at underneath the surface. So the biases 4 through 7 don't move as quickly, and they don't change readily. All right, and you'll see like here biases 5 through 7. You'll see they're back over at this point in the chart about 2:30 this afternoon. They all turned green. Okay, and you can see they stayed solidly green. So what that tells us, all right, that tells us even though prices action is kind of bouncing back and forth, and a little bit in what appears to be more of a sideways action, the underlying is very bullish. Okay, so we want to be primarily looking for longs. Okay, and again, we're looking for more structural longs rather than scalping longs. Okay, so again, the context of everything that we do here is going to be based upon more structural concepts rather than scalping. So anybody's welcome to scalp. We don't, or of those that do, they're on their own when it comes to that. But when I speak about levels and patterns, I will always speak in terms of structural patterns because I'm looking for something bigger. All right, I'm not looking for, I'm not going to like be a hockey announcer, and every pass to the defenseman and to the right winger all the way up the ice. All right, so there's no calling like that, as you all quite know at this point. But we want to keep you on the correct side. So that said, we're looking for shifts in the underlying changes in the dynamics in price. Okay, so one of the shifts is a shift in momentum. All right, so the way we have this structured is we have color backgrounds that indicate where there's, at what point in time in price is there a shift from bearish to bullish, vice versa. All right, I will be working on, this is on Sierra chart right now, and I will be working on this to get it in the same display on the Ninja charts in the near future. So simply the idea is we got a shift in the momentum. So the momentum indicator that we use, okay, right in the second panel here, and it's no mystery, so I'm going to fill you in a top secret. This is a, excuse me, a MACD Bollinger. Okay, so there's the secret. Cat's out of the bag. All right, this is a MACD, standard MACD settings with a Bollinger Band. What? Yep. All right, right out of the box. All right, so you can create this on your own if you wish. So what I simply done is color the background where when the MACD is above the now again there's some segments to it, but when the MACD is above the Bollinger Band and they're both crossing the 0 line, then that tells us that the momentum then has shifted either bullish or bearish. Okay, and then when that happens, the color changes from this reddish color to the green, and guess what? Game on for the long when it's green. All right, if you try to be shorting this when the momentum is bullish, good luck to you. Okay, so very simple, straightforward, but here's what I mentioned earlier. There is a contingency of algorithms out there in the world that actually are activated on this signal. Okay, now I don't know how many there are out there, and I don't know what capacity and sizes and so forth, but I do know that there are algorithms out there that will trigger off of this signal. So the idea of shifting in momentum is the idea of getting on the correct side, and this is what one of our core tenets of what we do is we always want to be on the correct side of market action. Okay, so there's your XMO momentum cross signal. All right, very straightforward. To get into the trade, there is no specific price point available here at this. This is just a conditional setup. So the condition is bullish, and we want to get on board that bullish condition. Okay, now how effectively you do that becomes, there are a number of different ways. You can use order flow on the right hand side here. All right, you can use bull bear stackers, which we'll cover next. All right, so with the idea of a shift in momentum, all right, we're going to go with that last shift in momentum. So here's a 750 tick chart. Okay, so here is that shift in momentum that we just looked at on the three. Now that was a 3-minute chart we looked at. What we've also done here is we've taken that signal from the 3-minute chart and we've overlaid it on the 750 tick chart. Pretty neat, okay? Capability of these platforms today are just wonderful. So this allows me to look at one chart, effectively, without having to go back and looking at all, number of different charts. Okay, so again, the color background is very simple, right? That tells me that on the 3-minute chart, the MACD Bollinger just shifted to bullish. Okay, so when it's turned green here, boom, it's bullish. But you can also see here on the chart, we have what we call a bull stacker. All right, and so we have a signal here called a bull stacker. Now again, the details of a bull stacker are, embedded in the membership materials and so forth, and we have an entire workshop that is dedicated to that. But suffice it to say that the bull stacker is just that. It is a bullish, strong bullish formation, all right, that you want to seriously consider taking a potential trade from. Now there is a reference price there. In this case, looks like 33.75. And what that reference price is, that does not mean that's an entry price, though it could be. Doesn't mean it's an entry price. It just means it's the reference price when the bull stacker signaled. Okay, so it doesn't mean that you have to be have taken that trade, when that signal generated. It just simply means that that was the price point from which the bull stacker signal generated. Okay, let me also show you this, because this is somewhat important. All right, this is what we call our Scanalyzer. All right, do I have the correct one? Yeah, I guess I do. This is what we call our Scanalyzer dashboard. All right, and what this does for us is it outlines and highlights all the setups that we have, all the trade categories that we have. All right, so again, the 3-day cycle is not any. Remember, 3-day cycle is a fundamental, foundational beginning for the day. All right, and every day. So what we would expect, as a day type. All right. Now, what we're talking about here as part of our method is the specific indicators. And again, what we're talking about here is everywhere where the rubber meets the road. This is where you're going to have opportunity to have trades work out effectively. Okay. Again, staying on the correct side, in alignment with the dominant force, as we discussed over and over, and of course staying in alignment with the day type. Okay, so we have we already talked about the ATR stop a little bit. I'll show that, and then you can see here stacker bull or stacker bear, which we're talking about right now, and the XMO, which we just spoke of. That's where the color background changes. All right, so as you're if you have the software on your desktop, you'll have this in front of you, and you'll see a visual and an audible alert, and then you can directly go to that chart and take a closer examination of what that signal is generating, and perhaps then decide to take a trade. Very timely. You can see the categories here coming up about turbo discounts and premiums and discounts there. There's turbo is just a faster, what the name implies. It's an accelerated signal. All right, and then we have the last category is extremes. Extremes can be used as exit points. They can be used as reversal entries, but I always would recommend extremes being exits first. All right, so that is our Scanalyzer that's available as part of the package. Okay, so the bull stacker. This is going to, again, when you get the signal, you're going to be wanting to get long, somewhere as efficiently as you can. You'll also see on this chart the ATR lines. Okay, so the ATR lines, let me just point to them here. All right, you see the white one here, and then you see the cyan color one here. Okay, so we use dual ATR lines. So when this ATR line shifts, all right, and it's shifted right here, so I'll give you a vertical identifier. When that that ATR line shifted from bearish, all right, so you can see over here to the left the yellow, to bullish, this is what we refer to as a structural shift. Again, when I talk a lot about structure, this is a structural shift. We're not trying, by the way, we're not trying to get the low down here. We're not trying to buy this low. Some people may. We're not trying to buy the low. What we're trying to do is identify that a low was put in place. Prices have rallied off that low. Prices have rallied enough to exhibit strong enough strength to shift the structure line from a bearish condition, all right, to a bullish condition. Does that make sense so far? So now at that point, once we have that structural shift identified, and again, it happens in stages, so we have two different ATRs, average true range. So it's the average true range of this chart, which is a 750 tick, all right? But it's still the average true range calculated. Now, again, when I talked about where I was on a committee back in the investment banking days, we were talking about the uses of the ATR. Okay, so this is one of the ways, although this is not exactly, because I could not take the exact configurations that we had, but the concept is the same. We're looking for shifts in the underlying price dynamics. Guys, I'm going to tell you right now, if you stay on, and our members can attest to this, I'm sure, if you stay on the same side of these ATRs, that's going to put you light years ahead of many others that are, that are looking at this price strength and saying, okay, I'm going to short those now. I'm going to short those now. Because now we got to bounce off of this low. Now I'm going to short them. Well, what will happen is if there is enough strength to shift the ATR, you don't want to be shorting that anymore. There will be times that prices will pull back to an ATR, but not shift them. That's the time that you want to be looking to enter a trade. Okay, again, in direction of using the ATR. And again, we have a trade category that talks about, that specifically identifies those conditions. So the ATR is very, very important to identify structural shifts. Okay, so again, this is a structural shift here. And then notice what happens, all right, after the structural shift, we ended up getting a shift in momentum as well. All right, so now we have a structure shift, number one, price structure shift. Now we have momentum coming into price. So we have a dual kind of signal here, supportive signal. And then thirdly here, we have this bull stacker that I just mentioned. All right, so really anywhere, I'm going to put a bunch of diamonds here, right? And I'm going to kind of put them randomly, because there's not one single price here that is going to be the best of entry prices. All right, again, since it's more conditional, we want to be in alignment with the shift. Okay, does that make sense? I worked for a money manager years back, and he basically simply said to me, when certain conditions, and they were very similar to what I'm talking about, but in individual stocks, and indices as well. Not futures, but it doesn't really matter. The concept is the same. Uh, once there was a bullish or bearish shift, and we were primarily buyers at that time, so we were looking for primarily bullish shifts. So when we had bullish shifts in the underlying instrument that we were trading, he would just say, let's get on it, quote unquote, let's get on it. All right, so we weren't price conscious. All right, but we didn't go chase after something. But what we wanted to do was once we had the conditions in place, we wanted to get on it. We wanted to take a position. So similarly here, once you understand the conditions that we're looking for, all right, getting on the trade, getting in alignment, I'm telling you, is like 90% of the issue. All right, that a lot of traders have. They don't believe that there's a shift. They don't even recognize that there's a shift. And again, the tools that we have, I will tell you, the tools that we have and we've created here are all the genesis of all our tools and everything that we have is from my days when I worked for the investment banks and my days when I worked at the hedge funds. Okay? Now you can trust me and believe me or not, your choice, but I will tell you everything has been the genesis from those days. So a lot of the tools that professional traders use in concepts, they may not be exactly what I'm showing here, but the variations of them, I can assure you they're taking action on these. And so these are the points in the charts and in the price action that we want to take action. Right? We want to get on board a bullish shift, right? Doesn't that make sense? Let's take a look at a bearish shift, all right, where there's a good bearish shift. We haven't had one. All right, hard to find one. All right, okay, so here's one. All right, so here's a bearish shift. All right, now this occurred, yeah, good, this was midday. So we had a period here where it was somewhat bullish, and then you can see here that the shift in the momentum and structure pretty much the same time. All right, you can see the shift in the colors of the background. You can shift in the ATRs here. So you got this push down here. All right, it broke the prior ATR. Right, so ATRs can break. So ATRs broke. That tells us what? That tells us there's a structural shift in price. So anybody that's long from above there, they're hosed. All right, so there is a structural break. What's the reason? Doesn't matter. All right, so once we get that structural break, we're looking for a pullback in price, and this is what I was referring to in terms of looking for pullbacks. Okay, so now we have a bear stacker, opposite of the bull, so we have bear, so the conditions are bearish, and in this case we got a pullback and it generates a premium. Now this is a premium. You can see there, I don't know if you can read the text there, but it says a premium 62.25. So the premium here is a short sell in the direction of a brand new weakening direction. Okay, that's the type of setup we're looking to get on board. Okay, if you didn't catch a break here right where it broke earlier, which most cases we won't, but once we get that move down and then we get a pullback, we're looking to get on board there. All right, so that would be a premium short sell. Okay, and then as you can tell here, the market, did continue down considerably. All right, reaching some lower targets, and again along the way there are some other signals that could have been considered, but the first one following a shift is always going to be, or at least the highest quality type trade setup that we're looking for. Okay. Yeah. So I think just looking at the list here, so we've gone over bull bear stackers, premiums and discounts. So this was a premium. Let me show you a bullish discount if we can find one. All right. This is yeah. So this is one right here, nice clean one. All right. So in this case, we're looking at actually this is a continuation of a bullish move. All right. We had a little period there. Market just kind of pulled back. It just generated a little a momentum cross back to the upside, but it immediately corrected itself. So price got back onto the bullish bandwagon. And again, color, stay with the colors. And again, this is not, by the way, this method is not like green light, red light, but the colors are meaningful in that I want to be on the side of momentum, and it's just a very easy visual to say, yes, I know bullish momentum, that's where I want to stay. All right. So as this is, and again, you could have, speaking of which, in this particular example, all right, we also, what you will also find is when we get a bullish shift in momentum, it's generally going to be associated with a bull or a bear stacker. So there's a brand new bull stacker. So just like the example we saw earlier, okay, when where it developed, the ATR shifted, and these ATRs were already bullish, and we got a renewed signal on the buy side. So this tells us at this point, okay, that there's the likelihood of higher prices to come. Now we see what happened, but again, the read is that we're expecting higher prices. All right. So again, you could get on board. Again, I'm going to put some random diamonds there. You can get on board in this vicinity here. All right. Put your offset stop, 2 points, 3 points, somewhere like that. All right. You're kind of a disaster stop. All right. And then you'll notice here prices moved up and then they pulled back. Okay. So this little shallow pullback here, all right, generated a discount. Now a discount on the oscillator down here is associated with that signal there. A discount is a pullback within the context of an upside direction. Okay, so this is where you have a number of opportunities. One, if you're monitoring the shift in momentum and the bull and the bear stackers, you get on board. Two, if you've missed that move and we get an opportunity to a pullback in price within the context of the developing up move, you have most of the times you're going to get a discount signal. Now, clearly we're going to be paying a higher price here. That's okay. The key is we're on board the direction. And again, you take that as any other trade. Take the trade, put your stop. Take the trade, put your stop. Okay, wash, rinse, repeat. But we want to be in direction of that primary move. Okay, we do not want to be shorting any of this just because you think for some reason that the market should be going down. Well, the market is telling us it wants to go higher. For what reason does not matter. The market price action and auction will tell us everything we need to know. All right, stay in alignment, okay, with the underlying direction, and you will always be, on the correct side, 90 some odd percent of the time. All right. Again, nothing's 100%, and of course, past performance is not indicative of future results, as we all know. But again, the whole design here to this whole method, okay, is to keep us in alignment with whatever the market wants to do. All right. And I've gotten questions in the past. Well, how effective is this? Okay. Well, I'll let our members, tell you guys if anybody wants to pass that along. But I would say that it's very effective. Okay, it's very effective because we want to stay on the correct side. It's very, very rare you see us on the wrong side of the market. Now that doesn't, and in most cases, you probably will never see us on the wrong side of the market. That said, that doesn't mean we don't get stopped out. All right, and we've seen stops. Stops occur no matter what. But I will tell you, we're on the correct side of the market all the time. All right. I know what the biases are. All right. I know what the directional biases, are in place, and we want to stay with those. And again, using our OODA loop matrix grid that we showed a short time ago. Now, just kind of scurry along here a little bit. All right. You can still see again. This was the entry opportunity down here, and you can see much higher. So that was 72, 73s, 76s. There's your 3 points. All right, 3 times 2. All right, 3 times 2. All right, $300. So here's a shift. Here's a shift. So, again, these are the things that you want to learn to, identify. So we're in an up move here, and then you start seeing in this vicinity here, things starting to get weaker, right? Down here, we have an indicator called the bid-ask volume ratio, right? In the third panel down. All right, you'll see it was all green and then it went red. All right, does everybody see that? All right, so it went red there. So this bid-ask volume ratio, what is that telling us? That's telling us, oh damn, that's telling us that the volume that's being traded is being traded more on the bid side. So we were talking about buy imbalances or sell imbalances. All right, so this becomes a sell imbalance, and you can see this visually that there's more being contracted on the bid. So there's bid side pressure. When there's bid side pressure in excess of offering side pressure, that becomes a sell imbalance. So when this oscillator is red, it's a sell imbalance. On average, it's called a sell imbalance. All right. Now on the order flow over here on the right hand side, you can see the green numbers and the red numbers, and those are specific price point imbalances. What this indicator, this oscillator is showing us, it's showing us an average imbalance, all right? So a persistence or sustainability of a buy imbalance or a sell imbalance. So over a number of bars, we're seeing that there's more action, in this case when it's turned red, that there's more sellers on the bid side than there are on the offer side. So that's referred to as a sell imbalance. After a move up, there's naturally going to be people wanting to take profit, right? If you're long from lower, and and it's not going any higher, okay, I'll start selling some, take some profit. That's natural. So when that occurs, we want to be aware of that. I don't want to be buying them late in the game, late in the move. I don't want to be buying them on this pullback here, because now this pullback is not showing me, all right, it's in the wrong direction now. It's in the process of shifting more bearish. And as we saw, I think this was yesterday, all right, as we saw, and again, you can see how the move can be pretty brisk, all right? So you would not be wanting to buy them there. You'd want to be looking to take, at least for nothing, stand aside, or possibly, nibble on the short side. So, and again, you'll learn to read the tools that we have. Okay, as a member here, not only the 3-day cycle and the daily trade strategy and all the fundamental core stuff to begin the day, but as the day unfolds, we have a lot of tools. Now, not everybody uses all the tools at the same time, as I mentioned earlier. Okay, so this is the core of, I think I covered all the topics here. We're at about an hour and 17 minutes. I don't want to go much further than that. Does anybody have any questions they'd like to ask here? All right, again, these are the core aspects of everything that we do, and you'll see these throughout the course of your trial in your period with us, and I'll work on highlighting these, as they unfold, throughout the day. All right. Yeah. So Christine says it took her about 2 months before learning them all. It does certainly take some time. All right, and there's nothing wrong with that. We have nothing, to use. We have a lot of time to do. And what I would suggest is, when you're looking at this stuff and learning it, take one piece at a time. What interests you? What resonates with you? All right, and once you find that, could be bull bear stacker, could be those premium and discounts. Whatever it is, you find it. And as a member, you can dig into it. Okay, so in terms of somebody asked me about the membership. Okay, and let's just quickly go there, and then we'll end it from here. So in terms of memberships and what you get with the memberships, I didn't have an opportunity to write it all out, so I'll just pass it along. You can go to the subscriptions page. Yeah. All right, you can go to the subscriptions page, and under the subscriptions page, the quarterly membership. So what you get in the quarterly membership is you get my guidance every day, trading room access. You'll get visuals on the charts, all right, as we display in the room. But again, I don't recommend you trading off the visuals of the charts, all right, for natural reasons. You get the daily trade strategy every day, all right. We talk about the setups, all right, and you also have, as a new member, you have access to 30-day free trial to the software. So everything we've shown you, it's not part of the core membership. It is an added, additional cost, but well worth the investment there, because everything we do, in all the setups that you will learn, in structures and concepts in the membership, are displayed, readily on the charts. Okay, so it's very practical stuff. It's not like, oh, I'm going to learn this stuff and all of a sudden, now how do I use it? Everything you learn in the website, in the members area, as a member in the core videos, we utilize on the charts. Okay, so if you're talking about a bull and the bear stacker, then you're going to see exactly what a bull and bear stacker is in a workshop, and you're going to see it unfold exactly that way. Okay, on the charts. JP, what do you have to help once you get into a trade? Exit stuff. So in terms of exits, okay, we have, we're in this connection time period right now. So all our setups here, and it's hard, I can't show you here, but the setups here will show you, it'll give you suggested exits. Okay, so the setups here, so on the particularly on the premium and discounts, okay, will give you an entry price, an exit stop, and a suggested risk-free point. So for instance, if you're risking, let's just call it 2 points, all right, it will give you the position size based upon your risk, and that will suggest you plus 2 points, minus 2 points, and then it'll have scales, suggested scale points. So everything is there for you in terms of guiding you out. But in terms of exits, that's somewhat of an open question, because the setup may give you a suggested exit, but a lot of times what you want to be doing is having a plan already in place. How are you going to exit a trade? What's your plan to exit a trade? If I'm in a trade, whichever the trade setup it is, if I'm in a trade, I'm risking 2 points, I want to be risk-free at plus 2 points. Once I'm risk-free, and I have multiple contracts, more than one, now I have the ability to select additional exit points based upon what the market activity is giving it. Could be a profile exit, could be a price balance target, it could be a number of different things. All right, so I do make suggestions along the way in terms of how to manage trades, but ultimately the management becomes your choice. And but we do talk about that within the context of the membership. All right, for sure. Did I miss any questions on the other one? Could you please explain a bit more about the opening range midpoint? So the opening range midpoint, Alan, is very simple. All right, whether it's the opening range or any other point. So let's go to the opening range chart. All right, do I want to use that one? Yeah, I guess we can use that one. So the opening range midpoint, you'll see it labeled here, ORMP, is the midpoint or the 50% point of whatever range. So if you have, let's just take, any range, hypothetical range, right? So you got this range high, range low, whichever it is. Let's assume this is opening. All right, it's going to be the 50% point. Okay, so I talk a lot about, and I use as an analogy the compass rose. All right, the compass cardinal points, high, north, south, east, and west. So in terms of trading compass, all right, it's going to be high, low, okay, and then midpoint. All right, so the midpoint is always a key reference point. of any range, doesn't matter whether it's opening, the initial balance, which is the first hourly high-low, so we're looking for the opening range, we're looking for the initial balance midpoint, we're looking for the daily range, whatever it is, okay, the daily range. Take any range you want. All right, there's 3 points to it. You'll already have the high and the low. You just identify the midpoint. Now, the idea of the midpoint is if price stays above the midpoint, okay, in a bullish environment, then that is bullish, right? Think about it as the 50-yard line. So if you're in the other opponent's territory now, right? So above the 50-yard line, right, you're bullish, okay? Below the 50-yard line, right, of course, it becomes bearish. So the 50-yard line or the midpoint is actually an active line in the sand, if you will. All right, no matter what range, choose whatever range you want. It doesn't matter. All right, but once you know what range you're dealing with, high, low, locate the midpoint, and then ask yourself, where is price relative to that midpoint? Is it above it? Is it below it? Okay, and you will immediately have a snapshot of, again, the immediate price action, whether it's in a bearish configuration or a bullish configuration. All right. So in terms of the opening range here, looking at this kind of the white area here, whitish area, this was today's opening range. So you can see here, well, today was somewhat choppy. It went back and forth around the opening range. But aside from this dip down here, price stayed above, all right, the opening midpoint. All right, and then what happened here, prices eventually pushed up above the high and then came down a little bit later in the day, all right, and tested the high. So the high became new support, and then as you can see, it responded off the high. Okay, so again, above the midpoint is bullish, above the high is more bullish. All right, a retest of that high usually is fairly successful, usually. All right, in all circumstances it won't necessarily be, but that's what you would be expecting. So anytime you consider any range, always consider the midpoint as the 50% kind of line in the sand. You know, bullish above, bearish below. All right, any other questions? All right, if you have questions, again, the remainder of your trial, all right, for those, again, you guys are only into about a week and a half of your trial, so we still got some time till the end of the month, all right, for those visiting with us. If anybody, you know, does want to accelerate, you know, their learning and they want to, you know, join up ahead of time, like a couple of folks have, by all means, we can get you up and running, you know, lickety split. Otherwise, enjoy your time. If you still have questions, you know, after, you know, reviewing the video, we'll address those, you know, in the coming days. All right. All right, we will end it there. Again, an hour and a half, a little bit more than the hour that I figured. But thank you for your questions, and we'll see you guys in the morning. Hope this has been helpful.